dual indexed floater. So a dual indexed floater is a kind of will work like a kind of bond, and in this case the coupon rate in the bond is calculated as the reference rate 1 minus the reference rate 2 plus some kind of margin. So the objective of the investor here is to earn the spread, or the difference, between the reference rate 1 and reference rate 2. Okay, so I've made a kind of example here. So if I were to create a real estate investment trust and then convert the cash flows of this trust into a bond-like exchange traded note, an ETN, then I would have a packaged ETN note with the following cash flow components. So first of all, if I start at the bottom here, the income, or reference rate 1 for the investor, would be the cash flows from the real estate, the underlying real estate itself. The cost to the investor would be the bank financing, which is reference rate 2, and the bank margin. So in this case, the reference rate 2 will be LIBOR, and the bank margin will be a 1% spread over LIBOR. So the financing rate, so if we move over, we get the following calculation. So the coupon on the ETN is going to be the real estate income minus LIBOR plus 1%. And if we come down, so we've got, for example, a 5% rental yield, and then we've got the financing rate here, which is the LIBOR currently 0.5% plus the 1% spread for the bank. So this is the bank financing rate, and this is the rental income. So the net coupon is going to be 3.5%, which is the 5% minus the financing rate. So this is how we get a spread. So we've got an income net of a cost of a financing rate, and this gives us a spread between two rates, an income rate and a cost rate. So the investment characteristics of the dual index floater are that the payoff is based on maximizing the spread between two rates, this spread. So in this case, it's the spread between the rental income and the bank financing rate. If the bank rate rises, the spread will contract. This means that this ETN provides an inverse correlation performance to interest rates. If interest rates rise, the bank financing costs will rise and the net yield will fall. So in an environment of rising rates, your spread would contract and the investment would become worse. So this investment would yield best results in a situation of very low rates for a very long time, combined with a high environment of high rental yield.